Welcome once again to Retirement Designed Differently with Billy Voyles. He's the founder of Fundamental Wealth Designs. He's a financial advisor. He's sitting right here with me. I'm your host, Spike Spangle. Billy, what's on your mind this week?
Spike, what's on my mind this week is the science behind the decisions we make about our money.
I was so glad that you picked this topic. It's something I've spent a little time studying myself. It's a field known as behavioral finance, personal finance. There's actually 7 decades worth of Nobel Prize winning economic research. There's some big names in the communities. I know you might think it's all about the dollars and cents, doing the alpha, the beta, the standard deviation. But really, one of the biggest mistakes that is made when it comes to our personal financial choices are our own biases and what's behind them, which create incredible blind spots. So you did a little bit of the research as well. What's one of the names you knew from this field?
Yeah, absolutely. The father of behavioral finance is Daniel Kahneman. And he wrote a book called Thinking Fast and Thinking Slow, which is basically how we come to decision makings inside our brain, which is one of the things we'll discuss. But there's so many areas and biases, and that's what we really want to tackle today, is help to educate you. Again, we want to educate and entertain. So help to educate you on the biases that might be getting in the way of you making decisions that are going to put you in a better position financially.
Right. So these biases, we can list them, we can kind of go through them. And I think what I'd like to do throughout the program is just have our viewers think to themselves, are these biases possibly affecting the way that you're making your own decisions? Let's start with one, anchoring bias. And they're usually pretty simple. In their name, there's a lot of the definition of it. But by our investment terms, what is anchoring bias to you?
Yeah, anchoring bias is basically tying yourself to a particular, statistic, or, you're using information that basically won't let you get you off that spot because you're just cemented to that one fact. And we had a client come in that had a position in Apple that was actually $900,000 of Apple stock, and their total portfolio was about $1 million. But they were basically anchored to the fact that Apple was always going to go up and always going to perform. And that may or may not be true, but they were ignoring the fact that they had 90% of their portfolio in one particular stock. Mm-hmm. And they were ignoring that risk by basically, they were anchored to the success of Apple that got them to where they were, but they weren't looking forward and making the decision on now what is the best thing to do going forward. So they wouldn't move off that spot.
Right.
And they ended up not being a client because they never did. And that's okay. That was just where they wanted to stay.
And that's a positive anchor. But there are also anchors that can sink your ship. So say the Apple stock were to drop, lose 50%, they would lose 50% of that value. Another way to think of the anchoring bias is, again, anchoring to anything like that, or even anchoring to a concept or an idea. One thing that a lot of investors use, they anchor to real estate. They say real estate, the best long-term investment I ever made. But in the long run, you can actually see that the stock market, over the same periods of time, the returns are almost 5 times, 10 times. But where do people get this anchor that real estate is such a consistent investment return?
Well, I think that they're anchored, but then they also move into this situation where they get this confirmation bias. And that's sort of the second area. So you go from anchoring and you go to confirmation bias. And you're literally seeking out information that's going to confirm your opinion and your position. And if you try to go out, find out, as an example, why real estate is great for you as an investment, you're going to find a whole bunch of information that confirms your particular bias on why real estate happens to be a great way to invest. Mm-hmm. But you're not searching for why should I not invest in real estate and trying to get counter information for that. You're confirming your own biases, and we do that a lot because we want to know, we want to be right. We don't want to be wrong. So we go find out information that confirms where we stand, not others' views, others' points of views.
It's just regular behavior. We don't like to go look for the information that's counterintuitive to what we already think, what we've been taught, what we already believe. Do it with politics. Whichever channel you prefer to watch, go home tonight, watch the other channel and see how long it is before you want to throw your remote at the TV screen. Yeah. We don't like to look for the opposite side. And it can be a very emotional. You were talking about this in a way about taxes, the confirmation bias. How so?
Well, a lot of times, we've been taught for the last 40 years that you should defer your taxes, defer your taxes, defer your taxes. Put your money in your 401k, put your money in your IRA, and defer taxes because taxes will be less in retirement. And we're not certain that that's true. And in fact, we know that in 2 years, taxes are slated to go up. So that's one of the reasons we did write the book, To Roth or Not to Roth. And that's one of the things we want to offer the audience today is this book, To Roth or Not to Roth. So when you see the bottom of the screen here, you'll see a QR code that actually is linked to our website where you can request your free book. And To Roth or Not to Roth is basically an overview of retirement planning, but it focuses in and it narrows in on tax planning strategies in retirement for you to get prepared, because we're not a believer that you should always just defer. But again, from a behavioral standpoint, you're deferring gratification at that point in time, and it's not human behavior. We like immediate gratification. We like immediate satisfaction. That is how we're wired since day one. So this concept of deferring gratification till later and actually experiencing maybe some pain of paying your taxes, because to do a Roth conversion, you have to pay your taxes now. But we're at the lowest tax rates in 40 years, so why would we not want to pay ahead some taxes at the lowest rates, especially if they're slated to go up in 2 years?
It's been nearly half a century, though, of education, of people saying, I want to pay as little in taxes right now as possible. Then you go to your tax preparer and they agree, okay, yeah, I get it. You want to pay as little in taxes. I don't think they retain clients by saying, I think you need to pay $3,000 worth of taxes this year.
Yeah.
Nobody wants to hear that. So we've all believed it. It's counterintuitive, but it really can be better for your retirement plan. If you start doing some Roth conversions, what are the benefits of having these Roth accounts in retirement?
The benefits of having the Roth accounts are really you take a big risk off the table. So most people we work with, the majority of their assets is in a tax-deferred account, which means you haven't paid taxes on it yet. You've deferred those taxes till now, and maybe you have this nest egg now of $1 million, $1.5 million in IRAs and 401ks. And what does that mean to you, though? Can you spend it? No, you have to pay taxes on it first in order to then spend it later. So what we typically do is in our tax planning sessions with folks, we walk through to figure out what is the appropriate amount of IRA distributions to take, what's the appropriate amount of Roth conversions on top of that we should use, and we can end up saving them significantly in the long run. And one of the areas that we don't discuss all the time, but it comes up a lot, is doing a Roth conversion in order to leave a legacy behind. Because there are tax rules that are actually tax advantage in order to leave the Roth account as the account to leave behind. So we could talk about that.
Okay. Folks, when you call the phone number and make an appointment, we'll give you a complimentary copy of the book here, To Roth or Not to Roth. We'll explain a little bit more of what it is, but it's essentially paying your taxes now to incur tax-free growth and tax-free decumulation in retirement that doesn't count against your Social Security. Call the phone number right now. Let's get you started on your own tax-efficient plan for retirement. 888-379-1846. More with financial advisor Billy Voyles when we get back right after this.
We've coined the term retirement design differently. People might ask why and how are you actually different? Well, 1, we are independent, take a fiduciary approach, and 3, we take a completely holistic approach at the same time. Having those 3 things at our disposal allows us to build exactly the type of plans we want, and we do so by following a very sort of specific guidelines in doing so. So the first is we want to create a foundational income plan for you. You have to know where your money is going to be coming from in order to spend it. Second is minimizing taxes, because we want to pay the least amount of tax legally possible over the rest of your life. Third is we want to make sure that we maximize sort of that risk-reward relationship. We find a lot of people coming in, they're paying excess fees, they're taking too much risk for what they're actually getting in return. And then last, let's have some fun. Because otherwise, what are we retiring for, right? We still have to have that goal, that why of retirement.
Welcome back to Retirement Design Differently with Billy Voyles, financial advisor and the founder of Fundamental Wealth Designs. I'm Spike Spangle, and we're going through some of our own behavioral biases, the things that get in the way of us making efficient both investment decisions, personal finance decisions. One of the big ones you said, though, is that people tend to, you got to explain this one to me, we tend to avoid losses more than we actually like to go after gains. What is that called?
Yes, that's referred to as loss aversion bias. So when you're too tied into being fearful, frankly, of losing money, you might not be able to take enough risk in order to make enough returns in order for your retirement plan to survive longevity risks and living 20 or 30 longevity risks, living 20 or 30 years into retirement. So if we're just have all our money in the bank and it's not earning any money for us, then we're just going to slowly get inflation to eat away at it. So this concept of loss aversion bias, and it goes back to people not having purpose for their accounts and not having a proper plan in place, and it all sort of goes back to that, but they'll just have all their money in the bank or, in mason jars or wherever they put it, but they're so scared to lose money that they're afraid to make money.
Well, right now, today, with where interest rates went, there is some safer money, and I'm using air quotes here, the safer money. But also, what are the markets doing at the same time? I mean, if you're getting 4 or 5% in a bank account, but you're missing 15% in the markets, I'm not saying that's a guarantee, but you're afraid of the loss. Does this happen more for somebody moving into retirement who is trying to preserve their wealth? They don't want to take those losses?
Yeah, absolutely. And I think people can be well off to the point where then they don't want to take any risk because they feel like they have enough. And that absolutely could be the case. And we have a lot of tools and resources that if you don't want to take risk in the market, we have a lot of tools and resources we can use where you still can be loss averse, but then have your entire portfolio set up to earn more and protect you over the long run more so than just sticking all your money in the bank. Because the fact is, interest rates are set to drop in September this year. There's about a 95% chance is what they say right now. So if interest rates are starting to fall, that means when you go back to the bank and you go back and get that high yield savings or go back and get that CD account that you had for 6 or 9 months that maybe was earning 4 or 5%, it could renew at 2 or 3%. And usually when we start trending in the lowering of interest rate directions, it goes that way for a while. So that's what our anticipation would be as we start to see lower rates, we start to see that reinvestment risk really pop up when it comes to the CDs. And the people that are, really risk averse are going to run out of choices. Right now they've sort of had their place to park the money. But when you say it, the market in that time's also been up 30%. So,
and if you look at the Magnificent Seven, those tech stocks, the Meta, NVIDIA, I mean, those have been up nearly 3,000%. And not saying that's the allocation you need to be in for retirement, but when you're more afraid of taking a loss instead of looking at what could be moderate gains, you incur stronger losses. One reason this might happen for those who enjoy watching the markets and timing it is overconfidence bias. I think this is something we see a lot of, don't you? Folks who think they understand where the markets are going to go next. Does that ever even work out, even for the high-end money managers who do it year after year?
Oh yeah, we've had a couple folks in lately that they're investors themselves and they sort of DIY and they are very confident that the market wasn't going to continue growing the way that it grew. And they ended up taking what's called short positions, which you're basically betting that the market's going to drop. And one of these accounts actually accumulated $1.7 million of capital losses that they brought in. But they were so confident in the fact that the market was going to continue to drop. And this was 6 months ago, and the market's done nothing but continue to rise since then. So I don't even know what their losses have accumulated to since then.
Let's bring it back maybe to our kind of more common viewer here in the Midwest, the overconfidence bias between a couple. Maybe there's one person who's been doing the investments and they'll come into your office, they've got their spouse with them. I know what I'm doing. I've done pretty well. But what about the spouse who doesn't have that kind of confidence in taking care of the investment? What happens if something happens to the family money manager? Yeah,
and that's exactly right. And this gentleman, he's actually becoming a client. He actually is taking the steps to get things in order because he recognizes that himself has a lot of confidence in managing his money. But if he's no longer around, he needs someone else, an advisor like us. He's bringing us into the fold to make sure his wife can be informed and they can have a smooth transition to her managing the money. And that's the most common situation, is that the guy sort of runs the money and the female, but that is changing big time. And we have a lot of folks who come in and the women's running the finances in the house and she's sort of taking everything over and the guy's along for the ride. And it's the same in both situations. If one person is dedicated to sort of running the entire financial picture and all of a sudden that person is no longer around, that spouse is going to really struggle because they're going through grief, they're going through the loss of a spouse, they're going through all these other things that picking up and putting together all the finances is going to be far down the list of things they can handle, let alone want to handle or need to sort of take care of.
Yeah.
So we're in the picture there in order to make sure they have a smooth transition of wealth to the next spouse in order to figure out, all right, now we can put it all in order and take the steps forward needed.
I think another interesting bias, though, is known as recency bias. We all do this. We're looking at our phones, we're watching the televisions, we're looking at our screens and our iPads, and we're getting all kinds of news alerts, whether it's market related, whether it's political related, whether it's worldwide news and calamity that's happening. We watch these recent events which affect our decision making, but is that really long-term investing if we're reacting to the daily news?
Yeah, the recency bias, I think, is one thing where you're looking at it and you think, you know, maybe the markets are going to go up forever because they have performed so well lately. So then that other real emotion kicks in and then you become greedy. And then you become too tied to the market. Or in some cases, you become too tied to your existing advisor because you feel like they're doing a fantastic job for you because your accounts are up. Everyone's account should be up. All of your accounts should be significantly up over the last 2 years. But is your advisor still tackling tax planning for you? Are they still structuring an investment and income distribution plan that makes sense for your particular plan? Or are they just managing your money and they happen to be doing well because the markets are up? We see a lot of that lately, and people are just they're not moving off their spot. They're sort of not, they're tied to the success of the markets and contributing that to their advisor.
Back to the anchoring bias that you were talking about a few minutes ago. As far as recency bias, I want to ask you about to Roth or not to Roth. I think this is a more recent word, at least for a lot of investors out there. Is this a fad? You wrote an entire book on it. Is this something that you are a fan of, or how exactly do you implement it? What's the book all about?
Yeah, absolutely. So to Roth or not to Roth, again, you can call the number today and request the book. We'll send you a free copy in the mail, or we have a QR code where you can go to our website and request a copy. To Roth or not to Roth really is a look at holistic retirement planning, but you can't be a holistic planner if you don't pay very close attention to taxation in retirement. So it's sort of dedicated to tax strategies in retirement. And the Roth conversion or the Roth IRA strategy is a way to pay your taxes now and then have tax-free growth and tax-free distributions for the rest of your life. So that is really how it structures in people's plans. It's different for everybody. A lot of times we're doing phased Roth conversions. So if you're out there and you're wondering, is a Roth conversion right for you? That's where you need to give us a call and set up some time to sit down with us. Because we can walk through your particular situation. And I'd say it's probably about 50-50. It makes sense for about 50% of our clients, and it doesn't make sense for about 50% of our clients. But we need to know details about your situation to walk through our entire process. So if you call us today, what you're getting from us is an opportunity for a complimentary consultation to schedule a foundation meeting where you'll come into one of our offices in the cities, and you'll sit down with us and walk through your tax plan, walk through your income plan, walk through your investment plan, and we're going to really dive into details about your portfolio too. Are you paying a lot of fees in your portfolio? What's the amount of risk you're taking in your portfolio? So we talk about a lot, and we're sort of going through a lot here today, but that's what it is. It's your entire retirement. So we want to make sure we walk through it in detail to make sure we give you the plan you deserve.
This is just one part of it, but also when you call the phone number, if you come in, we'll give you the complimentary copy. We can send it out to you if you call, but come on in, make the appointment. Taxes are an incredibly important part of your retirement design, and your retirement, as we say here on the program, is going to be designed differently. It's different than your neighbors, it's different than your family, it's different than your parents and your grandparents. We need to design it for you. So call the phone number down on the bottom of the screen. We have folks standing by right now to schedule an appointment. More with Billy Voyles, and you might need a financial advisor when we get back right after this.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Welcome back to Retirement Designed Differently with financial advisor Billy Voyles. He's the founder of Fundamental Wealth Designs. Today we're talking about a topic that I really enjoy. It's the behavioral finance, the biases, 7 decades worth of Nobel Prize winning economic research. We were talking about Daniel Kahneman. He's one of the grandfathers. If you leave out Richard Thaler, we're going to get phone calls.
Yeah, University of Chicago.
Yeah, Richard Thaler. These folks, they've put a lot of time into looking at the science of our behaviors. Mr. Daniel Kahneman this year passed away at the age of 90. He was considered one of the 7th most powerful economists around the world. Just really studied the ins and outs of it. There was one more big, though, bias that you wanted to go over. I feel like it's one that we're familiar with, but you said it was important.
Yeah, and I want to talk about herd behavior, which is basically following the herd. And that may or may not be right for you. And we run into this a lot. And I would just challenge that if you're out there and you're sort of uncertain about your decision making, and then you start to get into this pattern of, I'm going to ask my brother, I'm going to ask my cousin, I'm going to ask my bartender, I'm going to ask my hairstylist, I'm going to ask everyone possible that I can run into about what I should do about my retirement planning, and just following this generic herd device of, have you bought into AI? Or what about Bitcoin? Are you in Bitcoin? You should have bought Bitcoin because now it's way up. Or whatever it might be.
What about annuities? Or I hate annuities, or we love annuities, or this worked for me. Are they qualified to be answering those questions?
Yeah, and that's what you want to ask yourself is, who am I really asking for advice when it comes to retirement planning? I would say if you really want to get a broad spectrum, then go or see 2 to 3 different advisors. Don't ask general people that are, they're really savvy with money. What does that even mean? We work each and every day in retirement planning for retirees. And we work each and every day in designing retirement plans specifically for our clients. That's what we do. And more often than not, people are just asking someone they're good with money, is sort of what they say. I'm like, what does that even mean? I'm not sure. So
Yeah. All right, we've got to make sure that we leave enough time for it on this week. So if you need a financial advisor, you might need a financial advisor if, what is it this week?
And you might need a financial advisor if you're your own financial advisor.
Nice.
Because it's one of those things.
You're saying I can't be my own financial advisor? Our viewers can't be?
Yeah. And it's you're DIY. We call it do it yourself, right? And you're probably well versed. You probably do your own research. And it's more often than not, it's going to be in that couple, right? Where one of you is in charge of the money, but one of you really is distant and is just making sure the other's taken care of. Well, again, if that one spouse passes away, what's the plan?
Do you have a personal example or a client example? Anybody recently who's come in that sort of situation? Somebody who's maybe seeing that tree in the forest there, like, hey, I should get somebody to help, not just me, but when I'm gone.
Yeah, absolutely. And he was 60 years old. Him and his wife were both 60. They both recently retired. Had about $4 to $5 million in assets, really well positioned. And he recognized that he's not going to be around forever. Right, and he needed to make sure, because he had a pretty complicated picture. So he needed to make sure that, if he were to pass away, that she was taken care of, informed, educated, and he left her in good hands. And again, it could be either direction. It could be you're out there and you're taking care of your finances, and you want to make sure he's okay. That's okay, but again, things happen in retirement. Like, things happen that sort of derail plans, if you will. Whether it's strokes that leave people more disabled in order to do what they want to do. Mm-hmm. He's also sort of recognizing the fact that inevitably there'll be a cognitive decline of sorts. And his strategies are quite complicated, so he wants to sort of start to unwind some of those complicated strategies. So for him, we're actually leaving him with a slush bucket of money for now that he's going to manage himself. But we're taking over all the qualified funds, we're taking over the tax planning and distribution, we're taking over a significant part of his assets, and we're also fully informed on what's going on with the picture that he's still managing, so that in the event of, we can sort of put it all back together and make sure she's taken care of.
And let's also say, God forbid, in a quicker passing, that his spouse also has somebody to go to then.
Yeah.
And said, what do I do next? How do I get the funds? You'll already have a plan in place.
Yeah, absolutely. He just wants to make sure she's okay. So I would say that if you're out there and you're doing it yourself, but you know in the back of your head, there's a couple things that are going to happen over the next 5 to 10 years. And if you want to work with an advisor that's willing to work with you and let you still do some things on your own, we just want to be aware of them. We can be sort of someone to bounce ideas off of if you have them. We can run it through our portfolio analysis. If you have individual positions you want to look, we'll still partner with you and help you. But again, they don't want to give up total control either. So we're trying to work within the situation that makes sense for both of us, and we'll do that.
But also on the entire theme of the show is that you can also help point out to them what their own biases might be.
Yeah.
The tax bias, their own investment bias, either chasing after too many returns or too little returns, even biases in the estate planning and kind of the long-term vision of it.
Yeah.
You don't hopefully have doctors who operate on themselves or dentists who operate on themselves. The same thing with the financial advisor. In fact, do you, on your own, get a second opinion on what you're doing? Do you use outside counsel to say, hey, what do you think of this idea?
Yeah, absolutely. We have a team of advisors that we really partner with throughout the country. I have a great friend in Chattanooga, Tennessee. I have another great friend in Cincinnati, Ohio, Baltimore, Maryland. And we work with advisors. We are like-minded in our visions and what we like to do with finances, but we like to sort of, bounce ideas off each other to make sure we have the latest information in order to provide you with the plans. So we're wrapping up towards the end of the show. And we talked a lot about biases today. And one of the things we want to just walk through is what it means to sit down with us. And the first appointment is really just to get to know you. And that's what we're offering today, is for you to call in and come in and sit down with us, and for us to get to know you and for you to get to know us. That first meeting we call a foundation meeting, because we believe at the center of a good relationship is going to be a solid foundation. And then we're going to walk through what it means to create an income plan for you, to create a tax plan for you where we minimize your taxes, and then create an investment portfolio that's going to be right for you. And we're going to provide purpose behind the investments, because then we can achieve more growth for you, more growth for your family, and just create a better overall portfolio plan for you. So,
Billy, thank you so very much. I can't wait to show you my portfolio, see what biases and choices I've mistakenly made. But you can do that right here, folks. Just as Billy was saying, call the phone number down at the bottom of the screen. It's really that simple. There's no obligation. This is a sit down. This is a conversation. Let's find out what you would like to do, what you would like to design your retirement like. It's going to be different for you than your neighbors, your family, your friends. Let's design it specifically for your goals. Thank you so much for watching. Call the phone number. We'll be back next week.